But up first, I want to welcome back Rob Auclair, our financial planning and investing pro, back to the show. Rob, thanks for being with us again.
Thank you. Pleasure.
All right. Now, Rob, it's almost a cliche expression in the world of finance that credit is a valuable asset. And I think sort of most people understand that intuitively, but maybe you can kind of fill in some of the blanks for us. Why is credit so important for us in our lives?
Well, a lot of people think of their assets as the assets that are listed on their balance sheet, their house, their 401k, or a savings plan. But what they fail to realize is good credit, not just credit, good credit is a very valuable asset. And so a lot of times when we have to purchase a home or finance an education, coming up with those large lump sums is very difficult. And so by having good credit, we need to be able to obtain the amount of the loan that we get. So the better the credit that you have, the more of a loan that you'll be able to get. And secondly, also, your interest rate will probably be lower if you have a better credit score, therefore making your payment even less. But making sure that that amount fits into your budget does make some sense there. So good credit, very important.
Having good credit is going to mean being able to obtain some stuff that we can't necessarily save up for easily, like buying a house, but it's also going to mean potentially saving some money, qualifying for lower interest rates, better terms, things along those lines.
Yes.
How good your credit is usually described by your credit score, your FICO score. FICO was created by a company called Fair Isaac Corporation, but can you explain some of the components of what goes into credit scoring and your FICO score? I think we actually have a pie chart that kind of help us out with this.
Sure, yeah. So, you know, FICO downloads and gets the data from the different credit bureaus, and what they ultimately come up with is a score that we look at that can be in the range of 350 or 300 to 850. And the factors that are important are, the first is your payment history. So if we're borrowing money from lenders, they want to see how quickly do we, pay it back, or how timely are we going to pay it back. They're going to report, is it 30 days, is it 60 days, did they miss a payment? So that is the biggest factor, and I think you'll see on the chart there, that's 35% of the factor. Not far behind that is how much you actually have for outstanding debt. So they're going to want to know what that amount of money is.
How much you owe to other people.
Correct. And then the next thing is the length of credit history, how long ago you opened it, recent inquiries that you've made on that. Is also, a big one. And then the last one is your mix of credit. So installment loans versus maybe credit cards. They're going to want to see the mixture of, or they do see the mixture of mortgages, auto loans versus, credit cards and revolving credit.
Now, for some of us, maybe our credit score isn't what we want it to be. Maybe we've been turned down for a loan, or we're paying an interest rate higher than we think we should be. What are some things that consumers can do to improve their credit score? Because there are strategies for getting the number higher, are there not?
Yeah, and we talked about the biggest one is your repayment history. And so the best way, and I think we might have a slide that comes up here, is the best way is to actually start creating a long history of good payments. Make your payments on time. And again, it's not just your mortgage and your credit card. Everything could be all the way down to utilities in some cases. So make sure you're making all your payments on time. A good little hint is, if you got a problem doing that, use your bank as an asset to you to make auto payments.
If you have a problem with consistently paying your bills when they're due and things like that, because it's important. It's you pay it 35 days late, that's an issue, right? I mean, it's not like the bank's not worried about it. That is going in your record somewhere.
Correct. So again, we want to string together as long of a history, I guess, as we can, but make sure it's the good history. The second one that we look at is don't borrow up to your limits. So really what I'm saying here is if you have a $10,000 line of credit and you're carrying a balance of $9,500, $9,800 every single month, the creditors are going to look at that as you don't know how to manage your debt. So it's not a problem having that line of credit, but keeping it as high as possible is going to negatively impact that score. The third thing up there is, keep your accounts open. And I see this one happen with my own clients of, they work so hard to maybe pay off a credit card or some sort of loan over time, and then they just want to close it down. This is a great resource to boost your credit. Keep that open. Don't close it.
Build the history in the account so that the credit,
as long as it's good history,
have more information, right?
And opening and closing accounts, and this is the next one, limit your credit inquiries. Every time that you're inquiring for a new loan, that's going to go on your credit report and negatively impact that. And again, what that shows, future lenders or lenders, is that you're kind of desperate for money if they kind of see a lot of inquiries there. So that will negatively
So applying for it without really considering whether it's something you need or not, and you have a lot of inquiries in a tight amount of time, that could definitely be a hindrance to your credit score ultimately.
Yes.
All right, Rob, thank you for the information. If you want more